Hey, anyone got a light? Really? With the curtains still? What other government services are there to explain? Okay, that answers some questions. Not the color I would have chosen, but okay. I look like a tacky bank teller.
Would you like some coffee?
Pigs talking. Anyone else hear that?
Do you want out of this place?
Yes, I've been in here for what feels like decades.
Explain my purpose and defeat your doppelganger.
Your purpose? Like, as a pig, banks, really? That's not even a government's... All right, but what's a doppelganger? KB Morgan, better cash. How can I meet your financial needs today? This video is brought to you by CuriosityStream and Nebula. Did you know that the dollar is completely worthless? That's right, it isn't backed by anything. It could collapse at any moment, which is why you should put your money into gold, which I just happen to be selling. Not the actual gold though, I hold on to that for safekeeping. You get a certificate that says I'm holding on to a specific amount of gold for you, and why'd the music stop? What, you don't trust me? Right, so the dollar is worthless, but so is gold if you think about it. The only reason it has any value is because it's nice to look at. Using it as a currency actually takes it out of its useful application in electronics and other technologies. But that's not why the dollar... I'm sorry, so I have to bank battle an evil version of myself? Is that what's going on here? What? Oh, okay, it's like the third... Okay, Can I start over? In the beginning, the dollar was worth a set amount of gold, known as the gold standard. You could take your cash into a bank and exchange it for physical gold. Every dollar was like a gold certificate backed by the US government. People preferred using cash over gold since it weighs significantly less, and if a boatload of it sank in the Atlantic, we could just print more, while the gold stayed safely in a vault. Banks would hold on to the actual valuable asset while people exchanged a secure representation of that asset in their everyday transactions. All that changed in 1971 when Nixon took the dollar off the gold standard. Ever since then, the dollar has been a free-floating fiat currency and is just worth $1. Now, it is the valuable asset that the banks hold on to. Cash has become just as annoying and burdensome to work with as gold and silver was 100 years ago, and it's just as insecure. If you drop it in a fountain or light it on fire, it's gone. Which is why most people today keep their money in a bank and trade a digital representation of that currency, typically in the form of one of these. Generically, they're known as payment cards, but you probably know them better as debit, credit, or ATM cards. And the easiest way to get one is to open a bank account. Otherwise, you'd have to use cash or something, which, as we discussed earlier, is kind of... Or you can buy a money card from me. Don't waste your time with a Visa prepaid or Walmart store card. A KB Morgan Better Cash money card is just as good as the other guys and is accepted at just about any retailer. For a small $3 loading fee, you can buy stuff at the store or online just like everyone else, while knowing that your money is safe and secure. And if you ever need it out again, my ATM fees are competitive. Right, so if you want one of these without paying an upfront loading fee, you'll need to open a checking account at a bank or credit union. Banks and credit unions are two sides of the same coin. Credit unions offer the same financial services at slightly better rates. The only real difference is who owns the financial institution and why. Banks are owned by a corporation for profit. Credit unions are owned by its members for their benefit. They grew in popularity after the bank panic of 1907, when thousands of banks around the country failed and communities decided to pool their money together, like small financial co-ops or banking communes. Credit unions typically serve a specific group of people, whether they live in the same area, work in the same industry, or are part of the same demographic group. You have to be someone to join a credit union, whereas banks will serve anyone who walks in the door as long as they have money. They're both exclusive in their own way. For the sake of simplicity, whenever I talk about banking, I'm referring to banks and credit unions, since they offer the same services for slightly different reasons. Starting with the most basic service, a checking account. This is what's known as a transactional account, a specific type of deposit account designed to keep your money available for withdrawal or everyday purchases. The closest thing we have to a digital wallet. They're called a checking account because you used to write actual checks. This is an instruction to the bank, telling them who is getting the money, how much they're getting, and what account to pull the money from. But there is no guarantee that the amount you wrote down actually exists in your account. If it doesn't, the check will bounce. And intentionally writing bad checks is illegal. Because of that, many businesses and landlords have shifted towards cashier's checks, where they pull the money from your account and write a guaranteed check in the bank's name. Money orders serve a similar purpose but are typically sold by retail stores. Since personal checks are falling out of fashion, checking accounts usually come with a debit card, allowing you to shop online or in person and withdraw your money at an ATM. There is no additional fee to use an ATM as long as you're using one of our ATMs. If you're using an ATM at a gas station or something, the fee can vary anywhere from $2 to $5 and is the same whether you're withdrawing $20 or $200, in addition to our fee for not using one of our ATMs. Having quick and easy access to your money means that the bank can't use your deposit as capital for loans, so checking accounts don't usually earn interest. In exchange for having your money in our vault and using our electronic debit system, we charge an account maintenance fee, which can vary from $5 to $15 a month depending on what features
You can skip all of this at Better Cash. You don't need to pay a bank every month to keep track of what you spend your money on, selling your data to who knows who. Until people start taking Bitcoin seriously, the only untraceable currency is cash. No monthly account service fee, no ATM or overdraft fees. Just bring me your paycheck and I will give you your cash. Minus a small fee, of course, I have kids to feed. I'll cash anything up to $300 for just $3, and $6 for anything above that. I know that might sound like a lot, but it's still less than the $5 to $15 you'd be paying at a bank, right?
Okay, maybe we can work with you on the fee. Only 42% of checking accounts are actually free. If you have one, it's probably a special account for students or veterans. Or more likely, they waived the fees because you met some financial requirement. Opening an account starts with an initial deposit, obviously. You can't start an account with nothing. This can be as low as $25, but for a standard non-interest-bearing checking account, our bank requires $100, which is way better than the national average. Once you've opened the account, to avoid paying a monthly service fee, you'll need to maintain a minimum balance of $500. Basically, that $500 just sits there. Its only purpose is to prevent you from having to pay the service fee. Another option is direct deposit. As long as you have a reliable income of at least $1,000 a month, we'll waive the fees.
If none of those options work for you, we can consider opening another account.
This is known as cross-selling. Since banks exist to turn a profit, it's in our best interest to provide you with as many products as we can.
And the most popular option by far is a savings account.
This is a deposit account that the banks can use as capital for loans, so we don't charge a fee. And as long as you keep it open, your checking account fees will be waived too. There are some strings attached though. Since we loan that money out, you are legally restricted to only 6 transactions a month, and we provide an incentive for you to keep your money in our bank. As long as it sits there, it will earn interest. Savings accounts also have an initial deposit and minimum balance requirement, so again, let's say you open an account with $500 to start. After a month, the interest will be added to your balance. The national average interest rate on a savings account is 0.06% APY, which stands for annual percentage yield. Divide that by 12, and congratulations, you've made 3 cents. You didn't even have to do anything. There are other types of savings accounts, like jumbo or money market, that have much higher interest rates or dividends, but also much higher minimum balances. And then there are timed savings accounts, known as certificates of deposit or CDs, which typically earn a higher interest rate for a fixed period of time. You can't withdraw it early without a penalty. 0.06% is the average of all of them, which means for every high-yield online savings account, there's a brick-and-mortar bank that only offers 0.01%, like mine.
Savings account? Sure, I'll hold on to your money.
Do not trust him with your money. He's not FDIC insured. During the Great Depression, after thousands of banks closed their doors and millions of accounts vanished, the government decided to prop up the people. If your bank goes under, your savings account will still be there. The Federal Deposit Insurance Corporation will back any deposit account up to $250,000 with the full faith and credit of the United States government. The NCUA provides the same guarantee for credit unions. The Great Depression was not the first mass bank failure. In fact, they were pretty common back in the day. There was no regulation. Banks were often over-leveraged. When you make a deposit into your savings account, the bank typically sets aside a fraction of of that in reserve and then loans out the rest. This is known as fractional reserve banking. Of your $500 initial deposit, they save 10%, or $50, and loan out $450 to Bob. Bob deposits that $450 into his account at another bank, $45 is set aside, and $405 is loaned out to Catherine. This process repeats infinitely. In fact, your initial $500 deposit was probably the result of someone else's loan. This is how banks create money. It's also why if everyone who has money in a bank decided to withdraw it at the same time, the bank would run out of money. We call this a bank panic or a run on the banks. Most of our money was made this way rather than printing it, which requires a central bank to regulate the money supply. In the United States, we call it the Federal Reserve System, or simply the Fed, which is a system so complicated people assume it must be part of some giant conspiracy. We're not going to get into how it's structured, but we are going to briefly talk about how it works. They control the money supply through three mechanisms. The first mechanism is one we've already discussed. The Fed can adjust the fractional reserve percentage. The lower the percentage, the more capital banks have available to loan out, and vice versa. They very rarely change this number. More commonly, the Fed changes the interest rate on interbank loans. The lower the interest rate, the more money can be loaned out, increasing the money supply. The third mechanism is the most controversial, the buying and selling of government securities, commonly as treasury bonds. When the government sells bonds, they are taking money out of general circulation. When they buy them back, that money is reintroduced into the economy. That third option was famously used to bail out the banks during the 2008 financial crisis, because again, the banks were over-leveraged. It's a common talking point that the stock market crash of 1929 didn't cause the Great Depression. It was the bank panics that followed. But that narrative leaves out the crucial link between the two. Numbers vary, but only 3 to 10% of Americans personally owned stock. But back then, banks were allowed to use your savings account as capital to invest in the stock market themselves. So indirectly, just about everyone with money had something at stake. When the market crashed, it took thousands of banks with it, which caused a run on thousands of other banks, wiping out everyone's savings. So the government decided to stop that from happening again. In 1933, the Glass-Steagall Act separated commercial banks, which typically did savings and loans, from investment banks, which dealt with stocks and other brokerage services. Banks could not use deposit accounts to make risky investments, until it was repealed in 1999. It took less than 10 years for the banks to end up with more risk than capital and require a bailout from the taxpayers. Granted, that bailout turned a would-be depression into a less severe recession, but I'm still allowed to be mad about it. The one thing that differentiated 2008 from 1929 is that the banks weren't invested in the stock market. They were mostly over-leveraged thanks to mortgage-backed securities and their derivatives, like credit default swaps and synthetic collateralized debt obligations, which are complicated investment vehicles that are well above consumer-level banking services and not really in the scope of what we're talking about here. So let's discuss the underlying mortgage instead. A mortgage is a home loan that typically lasts 30 years, during which the bank owns the house and you are slowly paying it off, with an average interest rate of 3 to 4%. Car loans work in much the same way, but only last 5 years with a slightly higher interest rate of 4 to 5%. Your interest rate is determined by your credit score. There are 3 credit reporting agencies, Equifax, TransUnion, and Experian, that keep track of your financial history and determine how likely you are to pay off a loan. And they each calculate it a little differently. Your score ranges between 300 and 850. The higher the number, the more financially trustworthy you are. One of the biggest factors contributing to your score is your payment history. Have you been making payments on time? Next is your credit utilization. What good is approving you for a loan if you never actually use it? How long have you been using credit? The length of your credit history gives these agencies more data to work with, and having no credit history is worse than having bad credit history. How many new inquiries or lines of credit have you taken out recently? If you've suddenly applied for 20 different loans, that might seem suspicious. What types of loans have you taken out in the past? If you've only ever had a credit card, that doesn't really translate into something you have to pay a fixed amount for, like a car or home. The better your credit score, the lower your interest rate. To put that another way, the more money you have and the longer you've had that money, the cheaper buying a home will be. Car and home loans are what are known as secured debt. This is where you have a tangible asset that you've already purchased, and if you fail to make payments, the bank can repossess or foreclose on it. Unsecured debt can't be repossessed. The most common type is a student loan. They can't take the knowledge and experience back out of your brain if you file for bankruptcy, which is why they typically aren't discharged. If you want a loan for something you haven't already bought, we call that a line of credit, which is similar to opening a tab at the bar, the most common form being a credit card. Debit cards are attached to a checking account. Every time you swipe your card at the store, it's pulling actual money from your account. Credit cards work a little differently. Swiping your card runs up your tab at the bank, and they send you one bill at the end of the month. If you don't pay it off in full, it starts accumulating interest in the same way as any other loan, but at significantly higher interest rates, usually 15 to 20%. As long as you pay it off on time, you won't have to worry about that. And the longer you have the card, the better your credit score, which means you can apply for a better card. Along with better interest rates, many banks offer cards that come with rewards like travel miles or redeemable points or even cash back on every purchase, which is basically a discount on life by virtue of your credit score. Think about it. The better your credit score, the cheaper everything is for you, from a house to a car to toilet paper. It pays to be rich. But here's a question for you. If you have a credit card that gives you cash back on every purchase and you always pay it off on time to avoid any interest or fees, who is paying for that added benefit? You might be tempted to say all of the people who aren't paying off their credit cards on time, but that couldn't be further from the truth. Every card, regardless of type or who issued it, has a processing fee attached to every transaction. If you go to a store with a debit card and purchase something that costs exactly $50, the bank will deduct $50 from your account, but the merchant will only receive $49.30. Where did that 70 cents go? To the company that made the electronic transaction possible, known as a payment processor. Companies like Visa, MasterCard, Square, and Venmo. That's how most payment processors and credit card companies make money, not through interest or fees. That goes to the bank or whoever issued your card. How did they come up with 70 cents? Transaction fees are usually calculated with an equation. For our example debit card, it's 1.29% and a flat fee of 5 cents. Here's what that looks like graphed out. But this is a debit card. There is no line of credit involved here, and it doesn't have the same consumer protections. A typical credit card's transaction fees look more like this, at 2.64% and a 10-cent flat fee. For our $50 purchase, the merchant ends up getting $48.58. Okay, but that's a plain vanilla credit card. What happens if you're using a 1.5% cash back on every purchase rewards card? How much does the store end up with? $48.25, a full dollar less than if you used a debit card. The transaction fees on a rewards card come out to 3.3% plus 10 cents. So who is paying for that 1.5% discount on every purchase? While you could say in an abstract way that we're all paying for it through inflated prices, in a more concrete sense, it's the merchant. The only difference between a regular card and a rewards card is the transaction fee paid for by the merchant, and they don't get to pick and choose which cards they accept. They can choose what companies they deal with though. Visa and MasterCard cover everything from debit to credit to rewards cards. They are by far the largest payment processors in the US, so not accepting them would be a bad idea. But other companies like Discover and American Express basically only offer rewards cards, and therefore have significantly higher transaction fees, which is why a lot of places just won't take them. So most businesses have accepted that if they place a $50 item on the shelf, they will actually receive a broad range of profit depending on the payment method. Before you go thinking that cash is the best option for the merchant, once you take into account the time handling it and the transportation and security costs, it really isn't. And apps on your phone are even worse. Making that same $50 purchase with an app like Square or PayPal, the merchant gets just as much as if you were using a rewards card, $48.25. It's just a coincidence that $50 happens to be where they cross over. The smaller the amount, the worse the apps get. PayPal's fee is 2.9% with a 30-cent kicker. The best way to think about loans in general is that you're bringing future income into the present. Don't ask yourself if you can afford a $300 monthly payment. Ask yourself if you will make enough to be able to afford the full amount of that house with interest 30 years from now. If the answer is yes, it might be a good loan. When it comes to credit cards, it's not, can you afford this right now? It's, can you afford it at the end of the month? And if not, what is your tolerance for paying interest? Everyone has emergency expenses, and if you have a credit card, that allows you to pay it off later over time. If you don't have a credit card, then
you get to come talk to me. He's right. Loans are like bringing future income into the present, but not all of us have 30 years to wait. Sometimes we just need to make it until next week, or next payday. Just under half of all banks do offer unsecured short-term personal loans, but you have to be an existing customer, and many states cap the interest rate they can charge at 36% APR, or twice that of a credit card. The thing is, that's an annual percentage rate, and most of these short-term loans only last 2 weeks. Since the average amount for these loans is only $300, that means the bank will make a grand total of $4.15 on that loan. That's not even worth the time it would take to set it up. That's where I come in with a payday loan. It's completely different, you see. I don't charge interest. I charge a loan renewal fee. If I loan you $300, in 2 weeks, I want $350. If you can't pay it off in full, that's fine. We'll just charge you the $50 and roll the principal over into the next term. We'll do this, I don't know, 5 times. Then we'll start charging you $25 each term to start paying down that original loan. So $75 every 2 weeks. I see you doing the math in your head. Stop. The whole point is to incentivize you to pay it off before the next payday. If you don't, and you let the whole process finish to completion, you will have paid $1,150, which is almost 4 times the original amount. But again, that's not the point. You needed money quickly, and I provided it. And everything I just said is industry standard. I didn't make any of that up myself. You may have heard that payday lenders charge 400 or 500% interest, but that's not true. That would be illegal. Instead, we charge fees.
What?
And some of us have partnered with Indian tribes, giving us sovereign immunity so we don't even have to obey state lending laws.
That cannot be legal.
Yeah, well, it is. This is America. There are more payday loan companies than Starbucks and McDonald's combined. Every check-cashing, rent-a-center, cash-for-gold pawn shop is also a payday lender. I think if we were all doing something illegal, someone would have stopped us by now. And my customers love the service I provide. 25% of all of my loans have been renewed more than 9 times, and 75% of my income comes from those people. I accept payment in a number of different ways: cash, gold, debit, credit, PayPal, Patreon. You know, maybe if you had a better grasp of finance, you wouldn't be in this situation in the first place. A topic you can learn more about by going to curiositystream.com/knowingbetter. CuriosityStream is a subscription streaming service that offers thousands of documentaries and nonfiction titles that you can access across multiple platforms. Check out The Ascent of Money, a series that dives into the more technical aspects of banking, like real estate derivatives. Or maybe you want to see some of your favorite YouTubers compete against each other in the Nebula original Money. Nebula is a streaming service built by fellow YouTubers to give us sovereign immunity from the algorithm. All of my content is hosted there ad-free, and people who watch this video on Nebula are currently seeing an entirely different skit that doesn't involve a sponsor. Sign up for both by clicking the link below. They're currently running a sale where you can get both CuriosityStream and Nebula for only $14.79 a year. See, you're already being more financially responsible. Who am I kidding? We both know I'll see you back here in a few weeks.
The real reason you end up talking to a guy like that is because you're poor. It's expensive to be poor. If you can't afford to maintain a checking account, your job can't pay you via direct deposit. They have to give you a physical check, which you then have to pay a fee to get cashed. If you only make federal minimum wage, that's less than $300 a week, meaning that you get charged 1% of your income just to get access to the money you've already earned. If you want to use a payment card like everyone else so you can shop online and avoid carrying cash, that's another fee on top of everything else. And cash isn't very secure. It can be lost, stolen, damaged, or seized. Banks don't like serving low-income, high-crime areas. They've been closing these branches at an alarming rate, creating what are known as banking deserts, areas where there are no bank branches within a 10-mile radius. You might be asking, who even needs a physical bank anymore? Everything's online. And the answer is most people. 86% of account holders use in-person services every year, and 35% visit a branch at least once a month. Even when there is a branch, they're exclusive in other ways. People either don't have enough money to maintain a minimum balance, or they don't have the proper ID to open an account in the first place. Not everyone has a government-issued ID, at least according to an FDIC survey of banks and bank customers. 25% of US households are unbanked or underbanked. That is why people end up going to those shady trendy Mr. Money Instacash places next to the liquor store with bars on their windows, or cashing their checks at Walmart. Even people who can afford a bank account have to jump through a dozen hoops to avoid paying fees. What we really need is affordable access to basic financial services. If only there was a business capable of doing that with a presence in literally every zip code, even in towns with a population of 1. Reopening up postal banking would provide access to these services to everyone, just like they did until the late 60s. They did it before. France, Britain, Japan, almost every other country still does it. The only financial service the US Postal Service currently provides are money orders, which makes sense. It's a more secure version of stuffing cash in an envelope and mailing it. But they used to offer savings accounts too. Imagine if everyone had a guaranteed deposit account at low or no cost where they could get paid via direct deposit and have access to that money from just about anywhere. All of a sudden, all of America would be better off. Doing so might even turn those low-income, high-crime areas into potential bank customers as they become more financially secure. It's almost like crime and poverty are linked, and access to services through the post office is a potential solution. Wait, is that what all of this has been about?
You are free from this place.
Nicole, it's 4:30 a.m. and I just awoke from the most bizarre dream. I think it all started with shoes. Sorry this video took so long to make. As you can imagine, there were a lot of moving parts. If you'd like to start paying down your payday loan, head on over to patreon.com/knowingbetter. Or for a one-time lump sum payment, paypal.me/knowingbetter. Don't forget to credit that subscribe button or the join button if you'd like to be part of our banking commune. Check out the merch at knowingbetter.tv, follow me on Twitter and Facebook, and join us on the subreddit.